Right. Well, I think we'll at least start with introductions again. For those that have joined in the last minute or two, I'm Andrew Lance. I'm the Chief Investment Officer at Simplicity. With me is Shamubeel Eaqub, who is our Chief Economist. We're going to run through some slides, but I would please ask you to ask us questions. It's much more interesting for us to actually be responding to the type of issues that you want to hear about, rather than us just telling you what we think. But I will hand over to Shamubeel to at least work our way through these things, and we'll then follow up with some questions and see how long this takes. Over to you.
Awesome. Thanks, Andrew. Hey, look, I thought I'd share a few slides mainly because I think there's just so much going on out in the world right now. It would be great to be able to just put a bit of context around it. So I'll speak a little bit about markets, I'll speak a little bit about the global stuff, and then I'll speak a little bit about what's going on in New Zealand, because I think not everything is nearly as negative as we might be seeing in the headlines. So I guess to start with, right now we're seeing this extraordinary volatility in financial markets, and you would have seen that in your own KiwiSaver accounts if you've opened it recently. And you can kind of see what's going on in these two charts. On the left-hand side is the US markets pricing over the course of the last few years, but you can see the big drop we've seen just since the peak in about 3 weeks ago. So the US market is down about 8% from the peak, but we've got some stocks like the Magnificent Seven that are down much more, right? 20, 30, 40% in that period. So we're seeing this extraordinary amount of volatility, and mainly to do with this incredible uncertainty we're seeing from the Trump administration. But it's not even. You can see on the right-hand side, European equity prices have just really skyrocketed, mainly on the back of defense stocks, because there is this kind of big shift that we're probably going to see a big spend up in defense in many other parts of the world, because the US is no longer going to be the protector of global stuff. And what's been surprising is I would have expected quite a big increase in interest rates as a result of that, because of that uncertainty, because governments around the world were borrowing more money. But actually, if you look at these two charts, what you can see is that interest rates are elevated, but not much more so than in the last couple of years. So we've kind of got this extraordinary period where people are just trying to figure out where is the risk and how do I make sense of that risk and how do I price it. And Andrew, might want to jump in very briefly on this at this point, because you've been seeing quite a lot in terms of the overall movement of money around markets, both here and internationally.
Yeah, very interesting, really, but completely understandable. We, as an entity, have seen quite substantial shifts out of our higher growth funds into the conservative and defensive end of the risk spectrum, and recently been talking to an international entity that is echoing exactly those moves. That there's been quite a marked shift, again, not surprisingly, marked shift out of stocks into bonds over the course of particularly the last week to 2 weeks. It's been very, very, very much very recent.
And this kind of brings up to the old adage that it's not timing the market, but time in the market that really matters. And I think, it's hard to hear that when markets are gyrating like they are at the moment. But I think it is important to keep that in context. And let me just give you a little bit of context from an economic perspective of why what we're experiencing at the moment is so uncertain. On the left-hand side is just a picture of proposed tariffs. And I put the date of the proposed tariffs there because it seems to change by the hour from the US side of things, right? Tariffs are on again, off again. It's going to be 25%. No, it's going to be 50%. And there's so much volatility. It's less about the tariffs at the moment and more about the uncertainty of where is the policy setting going in both the US and the response from other places. But if you kind of take the tariff announcements at face value, the current level of proposed tariffs are the highest since the Second World War. So this is pretty extraordinary. This is much bigger than what we had experienced in the first Trump administration. And you can kind of see that on the picture on the right-hand side that shows that the flows of information, people, capital, trade wasn't really affected by the first Trump administration. So I think initially the expectation from markets and market participants was that, yes, Trump is talking a big game, but he's probably not going to follow through. Now there is a fear that he will follow through and it will create a lot of disruption. And it is that uncertainty of both the fear of it and I think the the realization that it will have economic consequences. So there are some big global themes that are coming through, and my sense is that where we're heading over the course of the coming decades is a return of history. We're moving from a period where geopolitics had been relatively stable, and the period that's coming up, we're going to see more conflict, we're going to see more fiscal pressures, and we're going to see more protectionism. And what we'll see that spilling over into is the politics is going to be much more volatile. We'll see more rapid changes in politicians. We're going to see more experimental, unorthodox policies being pursued. But it also means that things are going to chop and change a lot. We're going to see one lot coming in and doing something, and the next lot coming in and changing that again. And you might have seen that not just in the US, but around the world, many institutions, like government departments, ways we do rules and regulation are also under attack. For New Zealand, I think what that means is, yes, we'll see this impact we're seeing in financial markets at the moment, but we'll probably also see very real economic effects. Supply chains will become more disrupted. Technology will become much more political. Are we going to use US AI or are we going to use Chinese AI? Can defense and technology come together? Will we have cooperation when it comes to climate change stuff? So all of these things are just very much up in the air. And essentially, I think what we should plan for is less certainty, more change, more variability over the coming years. And the time in the market versus timing the market, I think this little picture here will give you a bit of a sense. This is for all KiwiSaver, but it will give you a sense of what has happened over the course of the last couple of decades. On the green bars on the left-hand side picture is the contributions we make from our pay and the employer contributions and the government subsidies. And those orange bars are those returns from markets. And what you can see is we've had some very big years of returns recently. But if you count it up in terms of where a pension, asset accumulates its returns from, about 80% of it so far has been from contributions made, and only 20% of it has been from returns. So of course, market volatility matters. Of course, it has an impact. But actually, the most important thing, if you take a long view when it comes to retirement savings, is being that consistent, regular saver. Now, it doesn't mean you should not think about what kind of fund you're in, the risk profile you're in. That's a structural, fundamental decision that you should be absolutely making sure is right for you. I might just give you just a quick view on what's happening in New Zealand, because I think there are some bright spots in New Zealand that's better than what we might be seeing in the international news, which feels quite frightening. And so, of course, we're not immune, but I think there are some reasons why we should take a view that New Zealand has some semblance of resilience because of our distance from markets, our political distance, but also because our economic cycle seems to be bottoming out. I love showing this picture. This is a picture of New Zealand overlaid on top of Europe and the UK. And you can see that as a landmass, New Zealand is actually really big. And that means that we've at least got that ability to kind of go, we've got land and we've got space. We don't have the same density problems that many of these other places are facing. That tension that we're seeing in many parts of the world is to do with people who are quite close together, and there's a lot of fighting across borders. Now, our borders are really far apart. And when you kind of draw a 2,000-kilometer radius around Wellington, not many big armies and navies around us. But if you draw a 2,000-kilometer radius around Berlin, you've got all of Europe, including Putin. So, there's a whole bunch of other issues and risks that other people are facing that New Zealand, in a way, is not facing in the same way. So we're not immune, but we do have that scale and distance for us that had always been pitched as a big problem for us, might be a little bit of a buffer just for now. Also, the story about New Zealand's exports, both in terms of our commodities and countries that we trade with, has become more diversified over time. We still have a lot of dependence on our main commodities, but if you just focus on that orange bars on both the left-hand side, which is of main commodities, and on the right-hand side, which is the main countries, you can see that that orange bar has grown over time. So we're still very dependent on things like meat, dairy, and forestry. We're still very dependent on China and the US as our biggest trading partners, but we have been becoming more diversified over time. And what that means is we're still exposed, but we're probably the least exposed we have ever been in our history. And so that's a good thing, but it doesn't protect us entirely. From an economic perspective, what we're seeing is that New Zealand economy's been through a pretty tough period. GDP per capita has fallen a lot in the last couple of years. A lot of that decline has been more in profits rather than in job losses and wages, because businesses are really hanging on to their workers, and that's a good thing in the sense that it gives us a stronger base to recover from. We're also starting to see a lot of the domestic data really starting to bottom out. You can see on the left-hand side, building consents have bottomed out. On the right-hand side, you can see retail spending has bottomed out. We had data out this morning that said it's probably just starting to pick up. So we're again starting to see that sign that those negative and challenging issues are beginning to slowly improve. We're seeing a lot of hope coming back, but not yet a lot of action. And what I mean by that, people are saying next year things are going to get better. This year things are still a bit tough, or right now things are still a bit tough. So we just got to be a little bit careful about this recovery. We want to see a little bit more evidence that people are not just talking about the optimism, but actually acting on it. And part of the reason why I think we are seeing this optimism return is we've seen that big cost shock of recent years really turn around. You can see on the left-hand side, inflation around the world has peaked and has come down to back to the target of central banks. And as a result, central banks around the world are cutting interest rates. And when interest rates are falling and banks are starting to lend a bit more money, those two things of cheaper money that's more available is a really big, important driver of the economy. So I think we are going to see these effects gradually flowing through to the economy. There are two kind of big headwinds that are, in my mind, facing New Zealand. The first is around net migration, which has slowed a lot. And the other is around fiscal austerity, which this government really promised when they were elected. So it's not surprising that we're seeing the government essentially still running deficits. On the orange bars, you can see the deficit as a result of investments, which is absolutely fine because we should be borrowing money to invest. And you can see also in those green bars that some of the deficits are persistently from operations. That means that tax cuts haven't been offset by efficiency gains and cuts in other places, which is a little bit of a concern because fiscal austerity means that it's one of those things that's a brake on the economy while some of the other things are improving. The disappointing thing, I think, of the fiscal austerity so far is much of it has been about a reduction in investment rather than a reduction in operating expenditure. So typically in a recession, you want to be investing more because that's the time when there's lots of spare capacity in the sector and you can fast track that stuff and it just gets better. But essentially what we have seen is that it's been the red projects that have been turned off by the blue team. So, it is what it is. But right now what we're seeing is that there's quite a lot of unevenness in the economy. And what we're also seeing is a bit of political risk that's coming through. It's very unusual in New Zealand to see political polls being just so close, only 1.5 years into the term. And when I was talking about the global stuff, I was talking about that uncertainty of politics. And it's not so much about what political views you and I have. It's more that as business and consumers, we want to have predictability and stability in the wider settings of government. And right now, what we're seeing is what's happening offshore might also be coming to New Zealand, where we might see political uncertainty playing a bigger part in what happens. So, these are kind of these left tail risks that are still there. And the final kind of risk for me is that there's been this slowdown in New Zealand's economic dynamism over the course of the last decade. Pretty much since 2023, we've had very little productivity growth. And most of that has been because particularly our primary and goods sectors, which had been very productive, had been very innovative, have really stalled. And it's not so much the services sector that's really hard to improve, but it's really been that big drop-off in productivity that we've seen in industries like construction, manufacturing, and farming. So it's a really troubling stall in places where New Zealand had historically been pretty good, and we've really kind of run out of pace there. When you don't have productivity growth, it's really hard for us to get economic growth that's of good quality, that's widely shared. So, there's a lot going on right now, and I think it can seem very negative from the outside, but I think that's a reflection of uncertainty that's really escalated. I'd like us to think that some of this uncertainty can be managed, but also there is a lot of uncertainty around politics and changes of governments that will probably be with us for the next foreseeable future. KiwiSaver will be affected, but we should keep it in context because, as I showed you before, it's really about time in the market rather than timing the market. I'd really like you to make sure that you're in the right funds because it should be something you do regardless, because it shouldn't be just about what's happening in markets at a point in time. In New Zealand, the real economy is bottoming out, but we're seeing a lot of unevenness around the world. I think there's a bunch of risks we should always be watching out for. But I think when things like today, in terms of the uncertainty happens, we just need to be able to separate out those long views versus the short views. And just remember that when it's your pension or savings, it is very much the long view that matters. And I'd encourage you to think about, have I got the right fund? Am I saving the right amount? Because markets will go up and down, but history shows us that there are more good years than bad years. So I'll leave it there. I think that's enough in terms of prepared remarks, and we've got lots of questions coming through, so let's pick that up.
We do, and we've got some very good ones. The first one I'll quickly cover off. I'll try and say who they're from. No, this one's anonymous. So I have my money in retirement fund, but also some that I am in savings. Should I take out my savings and leave my KiwiSaver? We can't give you personal advice. It really depends on your personal circumstances. But understand that once you are on the assumption, therefore you're over 65, your KiwiSaver you can use like any form of managed fund account. You don't need to take it out of your KiwiSaver. You can, once you've done your first withdrawal from KiwiSaver, no matter how small, the documentation's there, provided you're getting it paid into the same bank account. You can use it, as I say, like an unlocked up investment fund. In terms of whether you should use your savings before you use your KiwiSaver, I'm afraid that's way too detailed. We can't really advise on that. And then the next one's probably for me too, Shamubeel, and then I'm pretty certain they're all for you. How safe, secure is DWS? For those that don't know, DWS manage all our international investments. And there's 2 points here. Firstly, DWS are a global company. They have an office in Sydney. Our portfolio managers are in Hong Kong. Yes, they are based in Frankfurt, but I don't think there's any inference that the German political system is, for all that it does seem to be in a little bit of turmoil, is going to cause any major eruptions in their industry. So we're reasonably comfortable with, well, no, we're not reasonable, we're extremely comfortable with DWS as an entity. And then the other very important thing is that even if something would happen to DWS, your money that they're managing is actually in a fund that public trust control. DWS don't actually have control of any of your money themselves. They simply instruct public trust and as a custodian to move money around. So in terms of safety, we're very comfortable with DWS. So I think this is on to you now from what I remember. From Jonathan on YouTube. Shamubeel, are you still forecasting economic recovery in the middle of the year?
Yeah, look, I am. I think we are seeing all the signs that the New Zealand economy is bottoming out and we should start to see recovery coming through, notwithstanding those risks that I mentioned. So, the future is always unknowable, but what we're seeing is that people have cut back on their spending and investment so much that they've got some spare capacity in their budgets, both for households and businesses. We're also seeing the reduction in interest rates now flowing through to households and businesses because they're refinancing to low mortgage rates. So we are seeing those positive effects coming through. But the reality is that right now those big risks are really out of our control. Those global risks, we don't know what's going to happen to global trade or whether those tariffs will come in. We don't know if net migration will pick up, and we don't know if fiscal austerity is going to cause more damage. So right now, that's probably my big concern, is that we can see some of those risks that are very clear. But even though those risks are there, I think the broad story is still that New Zealand economy has been through a pretty big reduction, pretty big recession. And we have probably done too much, and we should be picking up from here.
Thank you. This one's an interesting one too, and I can't again see who it's from, I don't think. No. But interested in your gut feeling, not advice, on long-term challenges like climate insurance and shifting global powers in relation to ETFs and stock markets. The question being, could the past 60 years of market trends become less relevant?
It's a hard question, right? I think we are experiencing new risks, particularly when it comes to climate change and insurance in particular. I think those things are experiencing different types of risks. So when I talk to my actuary friends, they tell me that essentially we're moving from a scenario where the tails of distributions are now becoming fatter relative to history. So what we will see is insurance companies are going to be much more sensitive in terms of risk. They will be raising their premiums. They'll be less willing to insure certain things, and they might be using their powers to essentially push back on countries and places that are building in the wrong places or not managing their risks. So it's a complicated area. But when it comes to investments, I think what it means is that we've got new sources of risk when it comes to climate, in terms of the adaptation in particular. But also what we know is with geopolitics, this is a return of history. When you've got more geopolitical risks, there is just a greater level of risk in financial markets. That means there is more volatility. I don't know if it means that stock markets and ETFs in general will be different, in the sense that it means there's greater volatility, but doesn't necessarily mean that the returns on average over time are not going to be similar, because the years were the aberration rather than the norm. But it doesn't mean that the last 80 years is the only data set that we use to understand how markets work.
No, thank you. That's great. Question from Joshua. With the recent activity by the Chinese Navy in the Tasman, there have been calls for New Zealand to increase its spending on defence. If the government followed through with this, will that make a notable difference to the broader New Zealand economy?
Really good question. And I think the rough answer to that is, from a direct impact on the economy, it's going to be in two parts. One is around the actual additional expenditure in defense. Because most of the defense kit will be imported, we won't see an immediate positive effect on New Zealand. The downside of that increased investment is, where will the money come from? Most likely it will come from additional borrowing or reductions in other expenditure that we have at the moment. So there's probably a little bit of risk there that what we see is, as a result of the increased expenditure on defense, we see less spending in other parts of government spending that you and I might be dependent on. But from a geopolitical perspective, I think we know that most countries around the world will be stepping up on their defense expenditure, because if the US is no longer provide that security umbrella for you, you have to take some role for yourself, right? So I don't know if it's going to have a much bigger role on the New Zealand economy per se. I think it's more going to be around the fiscal pressures of, where do you find the money from, and the longer term picture around whether we can protect our very large exclusive economic zone. I suspect that's going to be the thing that's going to exercise a lot of minds in the beehive and amongst the spooks.
Yeah, great. You make sure I'm on the right one. You mentioned context is important in the current turmoil. Does this mean we should weather the storm and leave funds in balance and growth funds in the medium to long term? You want me to answer that, don't you? I mean, we can't give personal advice. Your personal circumstances, I know we say it all the time, we have to be very strict on that. But fundamentally, it is your personal circumstances that matter. The history tells us that growth funds over the 10 years plus period are the best performing. And so therefore, as I say, it just depends on exactly how long you're investing for. In KiwiSaver, you should be investing until you're well into your 60s, 70s. And so, as I say, it just depends on where you are on that line. Have I missed anything, Shamubeel?
No, I think just from a personal perspective, I'm remaining in my high growth fund because I will continue to save. So as I'm buying more of the KiwiSaver units, this weakness in the market means that with the dollar cost averaging, I'll actually be buying it at lower prices. So look, I think because of my age, hopefully I have enough life expectancy. That means that I should remain in aggressive for quite some time still. So that fundamental reason that this savings is for my retirement rather than something I need in the next 2 or 5 years means that that broad view that I'm in the growth fund remains unchanged despite market conditions.
Yep. No, that's great. Another anonymous question, but this one is probably more for me than you. With Simplicity's approach to investment, how are emerging organizations and their growth captured? Or do we only invest in those organizations, meaning they become part of the portfolio only when they reach a large market cap? Does investing in new growing organizations mitigate against shocks in the market that impact the established and large organizations? Goodness me, that's a number of questions in one. The key So the key to our portfolios is diversification. In our international share fund, we've got almost 1,000 companies. So if you think that through, the exposure to any single entity is quite small. Even those larger institutions like Apple and Microsoft only form a very relatively small proportion of your exposure to the world, if it were. And if we were to start trying to seek out growth opportunities in countries outside of New Zealand, that would require resources that we just don't have. What we did initiate, if you're a member already, you should know, is that we are looking at New Zealand companies that have characteristics that we believe are attractive, and we invest through an organisation through Icehouse, and we also have some direct investments ourselves in that private equity sphere, which, as you rightly say, can be insulated from the bigger risks that go on. If they've got a good business and they've got a good setup, they can make money regardless. And so, as I say, we've been trying to find companies in that sphere, but that's only within New Zealand where we can actually do some research and actually get some not inside information, of course, but detailed information that we can actually do some analysis on.
Andrew, I think it's also worth clarifying that those types of investments are a very small part of our overall portfolio. So most of our investments are still in that passive, low-cost investment in listed equities and bonds. That is still our broad ethos that if we can reduce the cost of investing for our members, that is the biggest, most efficient thing we can do for them.
Absolutely. And absolutely, Shamubeel, and you're right. We should always fall back on that. I mean, it's extremely important to note that the private equity investments are only within our growth and high growth funds because they are seen as being risky, but they're a very small part of the overall portfolios. Now, as you rightly say, and clearly that was how we set ourselves up in the first place, was to try and reduce fees as much as we possibly could. This one's quite specific. Building activity in Auckland is being increasingly constrained by infrastructure. Is this going to be a risk for the rest of the country?
Really good question. And the answer is yes, but also I'm quite optimistic that we're starting to see regulatory and policy progress on this stuff. So while I showed you a picture of government investment actually falling in the last 12 months, what we're seeing, if you step back, is over the course of the last 10 years, government policy around land supply and infrastructure is getting gradually better. It's not yet in fruition, but despite the changes of government, we've seen gradual progress to make that happen. So I'm feeling more optimistic that over the course of the next 4 to 5 years, we're going to see infrastructure supply becoming far more responsive. We're not quite there yet, but absolutely right now, there is a really big constraint in almost all parts of New Zealand, not just Auckland, where infrastructure capacity is not there and infrastructure delivery is very expensive, or we don't have the resourcing and capability. So really good question. I don't think we're out of the woods yet, but I'm seeing some really good progress that's bipartisan, which I think we should absolutely celebrate.
Yes, absolutely. And Shamubeel, you've recently been talking with farmers. What is their mood regarding the current economic situation?
Well, the dairy sector is probably going to have the best season on record. So we're going to see record profitability. So I can tell you Ashburton is absolutely buzzing right now, which is wonderful to see because it's a bit gloomy in other parts of New Zealand. It's a little bit uneven because in parts of the North Island, the conditions are really dry and we've got drought conditions in some parts. So it is that unfortunate reality that even with record prices, we are going to see an uneven experience across the country. But generally speaking, I would say the rural economy is actually a real bright spot in New Zealand already, particularly the dairy sector, doing really, really well this year or this season.
This one is for me. Why doesn't Simplicity provide a split option and the full amount has to be in one risk profile? Thank you, Alan. That question we've been asked many times, I have to say, over the years. And we fall back on the fact that administratively, there are some complexities to allowing members to have more than one investment in KiwiSaver. And we have, therefore, in order to maintain our costs as low as we possibly can, we haven't taken on that administrative burden. But without wishing to break confidences or etc. We are working hard on a solution which we hope we'll be able to implement fairly soon, which will allow you to split your investments between our funds. So apologies we haven't got there yet, but we are absolutely working on it. We have listened to the feedback, but as I say, on balance, we felt providing the lowest cost possible funds was the answer, and we've just about got to the point where we're going to be able to do that. And I think the next question is exactly the same: is when we'll be able to spread the risk across KiwiSaver allocation. So yeah, I mean, I appreciate that. That's, as I say, a bit of feedback that we've had over time. We're working on it.
I think the next question's for me.
Yes, very much so. I'll make a start and see how I get on.
Shall I summarize? Because I've read the question.
Oh, have you? Okay, you go then, please.
So I think the gist of the question is we're still seeing an increase in liquidations, business liquidations, and still job losses coming through. How confident are we that things are going to get better from here? And I think the answer to that is both business liquidations and unemployment tend to lag the economic cycle. So in fact, in the early part of the economic recovery is when we tend to see a lot of business closures, because the early part of the economic recovery is expensive and still uncertain. So unfortunately, I think what we have is still probably another 6 months or so of rising business closures or elevated business closures and job losses, because that's what happens in the late stage of that economic cycle. The unfortunate thing is, for example, if I give an example in the construction sector, in the early part of the recovery, we tend to see a lot of businesses pricing their new jobs too low. And even though the business is picking up, they've been so desperate to get work that they misprice it, and then they get into trouble, even though the order book is getting bigger. So just because the economic cycle is picking up doesn't mean everything is going to move up at the same time. In fact, what we find is there's a lot of variability in terms of which parts of the economy improve at what point in time. But again, looking towards the end of this year, I feel a lot more optimistic that the very kind of tough environment that we have seen both for business closures and job losses are going to get better. But we haven't seen the same kind of job losses as in previous years. We've seen business closures that are similar to the GFC, but most businesses that I'm speaking to are being very cautious about letting go of staff because they found it so hard to hire in the last 5, 10, 20 years, right? I've been working as an economist for 20 plus years, and pretty much the first report I wrote was on labor shortages. It's only just gotten worse. So yes, unemployment is going to pick up from here, but it's going to be a lot lower than previous cycles. So it's that kind of changing economy, right? We're running out of young people. We are running out of businesses to kind of take too much risk in terms of letting go of staff during recessions. So every recession we are experiencing is just a little bit different from the previous one, and this one is no different.
Great. I guess this one's for me too, actually, even though it's addressed to you. You used as an example of the choice between American AI and Chinese AI. China has the fastest growing economy in the world. Does or will simplicity increase investment in China? And if not, why not? I think that's mainly me. Right here, right now, China is not considered what the Chinese stock market in particular is not considered what's called a developed market. And the problem with investing in China from somewhere like here is just that the regime is still not as transparent and easy to negotiate as what's called the developed markets. I can personally envisage that changing quite markedly in the not too distant future. But what we content ourselves with, and so right here, right now, the index we invest in does not have China is explicitly. However, because China is such an enormous input into so many of the companies that we do invest in, and many companies that we invest in have a Chinese arm one way or another, we do get exposure to the growth that's coming through from China, just not directly. As I say, it's surely only a matter of time before the whole Chinese regulatory system, etc., gets to the point that it's accepted by the rest of the world. I don't know if you've got any views, Shamubeel.
No, I think it is that difficulty of investing in markets that are still different. I think when indexes, because our approach to investing is very much the passive approach to how we do things, very difficult for us to get access to low-cost investments in emerging markets, and that is one of the things that we need to think about over time.
The next one, we'll always preface with the not being able to give personal advice, but I'm looking to change my Simplicity KiwiSaver fund from growth to high growth. What do I need to be aware of with this change? Would now be the right time to make the change? What are the pros and cons? I'm in my 30s, have a high appetite for risk, and aim to use KiwiSaver only at retirement. So the difference between growth and high growth is actually relatively small, in the sense that within the growth fund, there is a 20% allocation to fixed interest, bonds. 80% of your funds are in shares. In the high growth fund, there are no bonds. And so I suppose in reality, the only reason that you would be in growth rather than high growth is if you're just feeling like you want to hedge your bet slightly, and not go all out into growth assets. I hope that doesn't constitute advice. I don't think so. But that would be why you would think about making that change. Next, is there any benefit in keeping funds in KiwiSaver versus equivalent managed fund in Simplicity for an over 65-year-old? I guess the only difference between the two, the fees are exactly the same in the non-KiwiSaver, in our non-KiwiSaver and KiwiSaver funds. And so therefore, no, there's no reason why you would. The only thing is that in the non-KiwiSaver, you do have the choice of splitting your investments between the different risk profiles, because it's not that from an administrative point of view, it's not like KiwiSaver. You do have the option of holding maybe even some direct shares or some global shares or some global bonds directly, as opposed to in KiwiSaver. So that would be, I think, the only real reason why you would want to move. From a cost point of view, if you like, and from a management point of view, they're both identically the same. Do you think this market uncertainty and volatility presents opportunities to buy shares in great companies at a good price? Of course. That's not advice, is it? No. I mean, and it's something that Sam says all the time is, you're buying stocks on sale when they've come down. Yes, they could still go down further. They could definitely still go down further, but ultimately, if you're steadily investing over time, then yes. How much are the investment funds in US stock, and is US stock overvalued? That's an interesting question. And I obviously wouldn't want to comment ultimately, but in terms of how much, it's about 60% of our global share funds are invested in the US. Whether their stocks are overvalued or not, the US economy has been the star performance in the globe for quite a few years now. That obviously looks like it might be stalling slightly, but I don't know if Shamubeel, if you've got any thoughts.
Look, I mean, valuation, we've been talking about like the Shiller Cape Index that's been really high for a long time. So, valuations are one of those things like, is it too high? It may be high, but does it mean you can predict what the next set of returns will be? I think it's always that richness of valuations on historic measures versus what is the market pricing in. Now, my sense is that, there is a lot of risk in the US right now. That's probably the bigger thing, is markets are reflecting that elevated risk of uncertainty. And that's why markets are in such a ruction at the moment.
Yeah. This is a good question. Read the graph about the proportion of KiwiSaver balances from your own contributions and investment gains. Is the high proportion from your own contributions partly related to how young KiwiSaver is? Will this not go down over time as balances build, blah, blah, blah? Yeah, absolutely.
Absolutely. But the longer you stay in the market, the bigger your savings become, and the returns are on what you have saved, right? So it's not just the returns that you make, but it's the time in the market. So you're absolutely right that by the time you reach age 65, a big part of it will be from returns, but those returns are because it's building on those additional contributions you're making every year. It becomes a flywheel about halfway through your working life when the returns become a much bigger portion of your accumulation rather than the contributions that you make. But you've got to stick at it for long enough for it to get big enough before the returns could really kind of start to do the flywheel effect. And that's why we keep on saying that it's the time in the market that's really important, that regular habit of investing and saving. That's what really makes the difference, because you can't predict when the markets will go up and down. But by investing, saving regularly and investing regularly, that's what gives you that flywheel effect over time.
Thanks. Question from Anne: is the Homes and Income Fund performing how you envisaged when Sam pitched it before? Yes, it is, in the sense that it's steadily building. It's returned 5% or so for the last 12 months, and at the moment it's still building up. It's the main area that it's going to actually get the benefit of is if and when the exposure to the property fund builds up within that fund. So far, largely the returns have come through investments in cash, with the property fund just slowly building up to its limit. So it's probably in line. We'd love it to be returning more, but we believe it will prove its worth over time. Question from Ben: from a diversification perspective, is there any benefit in investing across multiple funds that invest in similar? Who's moving the screen? In similar assets, i.e., global fund versus S&P index versus growth fund? I think I get the idea there. I mean, sorry, Ben, if I misunderstand what you're asking, but from a diversification perspective, pure diversification point of view, the global share fund has got about 1,000 stocks in it. If you're investing in our growth fund, then you've got a split between mainly the global share fund and the New Zealand share fund. The New Zealand share fund's only got 30 or so stocks in it. That's how concentrated New Zealand is, but you've still got that massive diversification in your international exposure. If you were in an S&P index fund, you're only exposed to the US. I'm not sure that answers the question, but the most diversification you can get, excuse me, would be in the high growth fund, if you're in mainly shares, purely because you've got all the diversification of the hedged, unhedged shares, plus some New Zealand shares as well. Not sure if that answers the question.
Yeah, maybe I can just try and answer it in a slightly different angle. For some people, especially when they reach retirement, they might have to like to have buckets of investments. So, for example, the spending money is in a very secure cash-like investment. The stuff you're going to need in 5 years might be quite conservative, and the stuff you want to spend in 20 years might be in high growth. So sometimes that diversification is more linked to your investment horizon and the purpose rather than for retirement. So in retirement, I think it can be quite expensive to have lots of small funds to be split across to get that kind of diversification. And also, correct me if I'm wrong, Andrew, within our investment in KiwiSaver, we have asset allocation across bonds and stocks.
Oh, sure. Yeah, depending on the fund. Absolutely.
That sense of diversification. So we're not going all into high growth and only growth without that level of strategic diversification that takes place from asset allocation.
Sure. Yeah. So as I say, the high growth fund is only in shares. The balance fund is 60-40 shares, bonds, and obviously conservative 90-10, 80-20 bonds. The question from Martin, which to be honest is quite topical, and I'll cover it off very quickly. Is information available comparing Simplicity Living and the other private investments in our funds? It's something we're beginning to be asked of. Obviously, the Simplicity Living investment is, gets a lot of noise for all that it's still a relatively small proportion of everybody's portfolios. And we're working on how we do this. There are a whole load of regulatory reasons that we have to make sure that the information is available to everybody, and that then means that's a resource thing for us to make sure that that's the case. But right here, right now, we don't have anything publicly available. It's something that we're working on very hard. Good question, I think, from Mike here. Why does New Zealand have a productivity problem?
That's the multi-billion-dollar question. We don't know for sure why it is that we have had this kind of absolute stagnation in productivity since 2013. And we're not the only country that's experiencing this. We're seeing this around the world in terms of slowing in productivity gains. And so that's why the Productivity Commission did all that work. That's why there was so much noise at Treasury and other places trying to unpick that. As I showed you in that chart, quite a lot of that loss of productivity for New Zealand so far has been the industries that were doing really well until now have lost pace. So particularly in the farming and goods producing sectors, the construction, manufacturing and farming sectors in particular, which had been doing really well, that had been innovating quite consistently and persistently, that momentum has faded. So I have a whole bunch of theories, but we don't know for sure. So it's one of those unanswered conundrums for now.
Okay. Question from Alex. Is New Zealand a trading nation rather than being an economy based on monetizing accommodation? And if the answer is not really, what high-value sectors are growing that have the potential to enable us to become one?
Man, some hard questions today.
That's it.
Well,
it's an excellent question.
It's an excellent question. And the answer is that we are a trading nation in the sense that about a third of our economy is in exports. So, we do export quite a lot. We don't export as much as European countries who trade across the borders a lot more. So, there is a little bit of that kind of horses for courses. There are reasons why our trading share is relatively low. We're also very highly dependent on housing. We all know this, when it comes to capital allocation in New Zealand. So if we look at where we borrow and lend money in New Zealand, largely it goes towards buying and selling houses from each other and not towards businesses and farms. So there is this weird kind of thing. We are a little bit trapped in a housing obsessed economy, but it doesn't mean there's not other things that also happen. It's just that those other things are not being supercharged. So to your second part of your question is, are there high value parts of the economy? The answer is absolutely. There are many, many excellent businesses. The challenge for New Zealand is we have many excellent businesses that are relatively small and they're not getting big. So when I look at the productivity challenge in New Zealand and the trading challenge in New Zealand, what we tend to find is we have many businesses that are very good, that are very small, but they tend to find it really difficult to grow from small to medium, because that's when productivity falls. And those very large businesses tend to be, again, quite successful. So there's this valley of death in the middle that seems to be a real problem. It's not about picking particular industries per se, but you can think of our gaming industry, video gaming industry, for example, absolutely world-class. You can see lots of the innovations that take place in New Zealand, like we have seen in farming until recently, that have been absolutely world-class again. So there are lots of things that are happening in New Zealand that I'd say are superstars, but they're relatively small and they're not getting big enough to really kind of drive the overall economy.
Great. Another question from Ben. Similarly, with the current global uncertainty for someone that's gone, sorry, for someone looking to still invest in international stocks, is there any benefit in choosing hedged or unhedged? That's such a difficult question to answer, but the reality is, if you remember that if you're in the hedge portfolio, your only exposure is to the New Zealand dollar. Whereas if you're in the unhedged exposure, you have a very diversified currency exposure, as well as the diversification of the share portfolio. Now, in our funds, we have half of one and half of the other. And that's something which we've recently implemented. I don't want to make any comment about what I think the New Zealand dollar is going to try and do over any period of time, because that is so unpredictable. But all I would say is that's your choice. Is you either have New Zealand dollars and your international shares, or you have international shares and international currencies. And so you would argue there's diversification benefits to being unhedged, but it may be that you prefer not to have currency exposure. Anything you want to add?
I think the only thing I'd add is that the New Zealand dollar tends to be quite volatile, in the sense that when there is a risk event, the New Zealand dollar quite often works as a shock absorber. So having that unhedged position can quite often moderate the pain of financial market movements, because that depreciation in the New Zealand dollar means that you don't experience the same kind of pain. But again, it's very much the fundamental question of what kind of investment exposure are you trying to achieve?
Right. The question that I've just lost is diverting accessible KiwiSaver funds into your home and housing fund an option to consider when thinking about diversification? Try and keep that succinct. The Homes and Income Fund is building up towards having a quarter of it exposed to the Simplicity Living initiative, our property fund. Our other funds all have a small allocation to the same thing. So I would actually say probably it's not a diversification benefit, but if you like the story about investing in rental accommodation for New Zealand, then that would be a reason for investing in the Homes and Income Fund rather than leaving it all in your more diversified KiwiSaver or non-KiwiSaver funds. I'm not sure that really answers the question, but it's not an easy one to answer because, as I say, from a purely diversification point of view, our diversified funds have the greatest degree of that. But the Homes and Income Fund, if that property story resonates, then that's got more of it than our diversified funds. Question from Ben. We've lost about 600 jobs out of the public service sector over the past year. Do you think this is going to have an impact on GDP growth in New Zealand going forward?
Yeah, really good question. And essentially, maybe we can answer it in a bigger way, in the sense that New Zealand has long had an issue with very low levels of research and development R&D spending compared to our peers in the OECD anyway. It's very difficult to show the causal link between science and R&D into economic growth, but we know they're one of the preconditions for having innovation and dynamism in a country. And so New Zealand's already been behind in terms of research and development. And I think the reduced funding in sciences is a risk that we see even bigger kind of drop off in the quality and quantity of science and research that's being implemented in the real economy. But can we see the direct line between science and economic growth? Not really. But in very specific areas we can. So, for example, in farming, in dairy farming, for example, the fact that we have the amount of milk produced per cow increasing for 40 years is as a direct result of really good science and innovation in genetics and feeding and all those other bits and pieces. So, it's a little bit of that. It's quite hard when you take it at a macro level to be able to see the link, but it's one of those things that we know from a fundamental perspective, research and development is a weak point for New Zealand, and unfortunately, it's getting weaker.
Yeah. Okay. I've heard a few investors, anonymous question, I've heard a few investors questioning recently how passive the high growth KiwiSaver fund is because of the index tracked and the investment in Simplicity Housing. Do you have a response to this? And please, can you remind me why you have the blended benchmark index you have? First of all, I mean, there's actually a few pieces to this in the sense that the index we track, if somebody were to perceive that to be an active choice, we simply believe that screening out the industries that are screened out of our index is the right thing to do and will be beneficial long term. Other entities in our sector are making similar sort of moves. Fossil fuels have been stripped out of default funds already. Weapons, pornography, gambling, alcohol, all those things which we strip out of our index, we still passively manage that index. So they're stripped out at an index construction point of view, and then we simply invest in as I said, it's about 1,000 stocks that are left in the index. So that from my perception is passive. The perception that we've made active choices, I can understand, and we have to a degree, but we believe those are places where we can add some genuine value. So in the initiative that we've made into this rental property, we believe returns to investors over time are going to be extremely good, and that is an opportunity to make reasonable good money out of doing something which is good for the economy in general. And then there's that small allocation to private equity, which we mentioned a little while ago, where we're trying to find companies in New Zealand that are still growing and just need some extra capital. So I still believe that I think we call it predominantly passive, but we've just taken a little bit of our funds to add value where we believe we've got some genuine advantage. If you got any?
I'd add, Andrew, that I think the reason why we have chosen those other bits is one, that we think the risk-adjusted returns are high. So I think we've got a competitive edge in terms of being able to create returns from our members that others can't. And two, it's still a relatively small part of all of our portfolios, right? So the offerings is we're still trying to make sure that it's low cost, so that we're very consistent that it has to be consistent with a low fees approach. Our philosophy remains the same. That the return should be good and that they should be ethical. So, and our ethical approach is very much about screening out by exclusion rather than by active investing. So it is a lot of things to try and optimize. And that's probably where I think some of that confusion or maybe some of the challenge comes from.
And the final part of that question about the blended benchmark, I'm not quite clear on. So the benchmark that's published in our quarterly fund updates, for example, that is made up of, if the fund was fully allocated to each of the asset classes that it does, the benchmark from all of those feeds into the blended benchmark. So we're judging each part of the portfolio against its proportion of the benchmark that it's benchmarked against. I'm not sure whether that's an answer, but it's hopefully if you need a better answer, do a repeat question. This one's similar to a previous question. As a retired person, is it wise for me to take money from my balance fund and put it in the homes and income fund, since the return for that is quite low? What are your thoughts on how returns will develop? What factors influence returns in this fund? The homes and income fund maximum allocation to the property fund will be 25%. We believe the property fund over time will be a very good investment for our members, but it's not liquid in the sense that we can't make it freely available to everybody because it's not something that we can control. I think I'm not able to predict what the return will be. We believe, as I say, it will be a very good investment for our members. And it's so hard to advise. As I say, if you like the story and you understand the property angle that we've got here, then probably it is a good investment for you. But that's down to your personal preferences. Any general investment advice for those of us who are closing in on retirement? Time in the market is running out. I mean, it's so hard because, again, without knowing personal circumstances and really understanding what your risk tolerance is, where you are in, and obviously you don't know what your life expectancy is. So with personal advice is so hard. Time in the market is running out, possibly, but fundamentally, as Shamubeel has said already, provided you're just ticking in the whole time, it's still worth maintaining that, unless you really have a need for certainty. I don't know if you've got anything you want to say which is not advice, Shamubeel?
Well, I think it is about getting good advice. I think if you're reaching retirement, you really want to make sure you're in the right kind of risk profile for your circumstances. And like I said before, when I've talked to financial advisors, especially for my parents, they've always said, make sure that your money is chunked up because you're probably going to live a long time. On average, we're going to be in 20 plus years in retirement. So you want to make sure not all of your money is conservative just because you're 65, because you're not going to use all of your savings in one go. So having really good advice and making sure you've got the right bucketing of your investments once you reach retirement is really important, but also in the lead up to it to make sure you've got the right risk profile in what you're investing.
No, good answer. Question from Steve on YouTube. What are your thoughts about global productivity growth? Will it keep increasing at historical rates?
Well, I think that was kind of what I was trying to get to earlier, is we're not the only ones who are struggling with this slowdown in productivity. It's a problem that's affecting a lot of other places. And I think right now the hype is that with AI, that's where we're going to find the next bit of productivity growth. We don't know for sure. But it is true that we are finding productivity gains much harder around the world. And there's a lot of conversation around the world around policy circles in terms of what can we do to try and unpack that. And the answer is we don't know for sure yet. So the general assumption around the world is we should be assuming productivity growth in general will be less than we have experienced in the last 30 years.
Okay, well, the next question feeds on from that. With the global economy bottoming out, what confidence do you have that it's going to start growing? I think that's what it was.
Yeah,
what confidence is the bottom's there?
Well, I'm not confident the global economy has bottomed out. I think the New Zealand economy has bottomed out, but I see an extraordinary amount of risk in global economy right now. We don't know for sure how to make sense of the, essentially the ripping up of economic systems, how we have done economics, trade, global cooperation around military stuff. All of those things were part and parcel of the wider economic environment, and all of those things are being rewritten right now. So no, I don't think we can predict confidently the global economy is going to be great this year. I think what I'm saying is that I'm seeing a lot of global risks, but despite that, I'm seeing, relatively speaking, New Zealand's kind of starting to bottom out. I'm not nearly as confident about global economic conditions, which of course affect us because we are a trading country, because we are reliant on global kind of rules-based approaches to trade and shipping and things like that. So I'm trying to be optimistic, but I can see a lot of risks out there.
Yeah, agreed. And to a degree, this feeds into the next question, which is about the US in particular. Do you think US trade volatility is likely to have much effect on the US dollar, or is hedging worth considering?
Look, I mean, your guess is as good as mine. When I first started as an economist, I put together the forecast for the currency at the beginning of the year from all the economists, and the end point of the currency never fell within the range of forecasts. So we couldn't predict the direction or the magnitude of the currency in 12 months' time. So I think what you need to think about is, again, that personal aspect is, can you manage the risk? If the currency goes against you, would you be okay? That's how I think you'd think about that particular issue.
Would a US recession affect New Zealand?
Absolutely. It's our second biggest trading partner. So we benefited massively from the US economy's extraordinary strength over the course of the last few years. Our exports to the US have grown massively, while many other trading partners had been going backwards. So a slowdown in the US right now will have an effect on many of those industries that had benefited from their growth. But it's also the spillover into the wider sector where, because the US is such a big consumer of products out of Europe, out of Asia, any slowdown in the US will affect those other markets who we are also dependent on. So we get the first-hand and the second-hand effects.
Yeah. There's a lot of US questions. Do you think current economic models can cope in the context of unprecedented US tariffs?
No, absolutely not. Tariffs had essentially been things that we stopped worrying about because it was considered a pre-World War II type of artifact. And all of a sudden they've come back. But it's not just the tariffs, right? It's also the fact that the rules of the game have shifted. So not only have we ripped up the rules of the game, we've also introduced these kind of very old school kind of tools, that unorthodox policy stuff that I was talking about before. And economic models had largely abstracted these things. And that's why I keep on talking about risk and uncertainty. It's that we are living in a much fatter tail world where there's just a lot more uncertainty, a lot of lack of knowledge in terms of how these things will transmit. And it's not just tariffs, it's whether those tariffs will be implemented and for how long and how predictably. For business, it's not just what policies are being implemented, but whether you know that it's going to be predictable and it's going to be implemented in a particular way. All of those things are being undone, and I think that's where our economic models absolutely cannot deal with that.
Okay. So the next question, which is how quickly can the global economy recover? It's probably exactly the same answer, which is it's really difficult.
It is really hard to tell, but it's also, I think it's about stepping back and going, are there some big levers that we can see that might give us confidence? And at the moment, I'd say monetary policy by and large is really positive, but the institutional factors in terms of institutional instability, the political kind of instability, the regulatory uncertainty are the things on the opposite side. And we don't know for sure if the monetary policy will be strong enough compared to all these other uncertainties that are coming through.
Okay, we're jumping back to New Zealand now. It's Jonathan from on YouTube. We've seen 368 liquidations or insolvencies so far in 2025, indicating a rolling average of 2,200 year ending March.
I think we
Figures will
answered
cause
this
this to
question
rise.
already.
Did we?
Yeah,
Something very similar.
yeah.
Okay.
Essentially, the answer to that is both liquidations and unemployment are lagging indicators.
Yeah.
So
Yeah.
this point of the economic cycle, these will still go up. It's only once the economy's recovery is old when we will see these things coming off.
Cool. And sorry, I realised that while I was reading out something that we said. Okay, we are already 50 basis points ahead of the Fed and forecast to jump another 50 basis points. How will this affect treasury yields, exchange rates, and trade deficits? Wow.
I could write a whole book on that, right? It's an extraordinarily big question. And I think the answer is, generally speaking, the yield differences mean that the New Zealand dollar would weaken. But because of the uncertainty now around the US, that's become less predictable. And again, I think it's Pete's question before that, can our economic models grapple with the uncertainty and the new things that are coming through? The answer is no. And I think therein lies the challenge at the moment. Generally speaking, we would have expected that difference between US and New Zealand interest rates would be making the New Zealand dollar weaker, making our exporters much stronger, our trade balance getting better. But we can't be sure in the current uncertain environment.
No. This one from Peter on YouTube has come up many times in the past, and actually you and I have never spoken about this, I don't think, Shamubeel, so I'll be interested to hear what you think. Would you consider adding Bitcoin to your portfolios, considering it is a incredibly neutral network with a 10-year track record, not controlled by a country or corporation, to hedge geo and climate risk? So, I mean, I can answer let me answer one little piece of this, and that is that for all that it's been around a long time and that it's, gets talked about virtually every day, it's highly unregulated. And that, from our point of view as looking after people's money, is the single biggest reason why, at this stage, the answer is no. But I don't know if you've got any broader comments, Shamubeel.
My broader point would be that while it is, in theory, an independent thing, it is trading like a very volatile bet on geopolitics. So, for example, the Bitcoin hedge funds are the ones that have fallen very sharply on the Trump trade. They rose very sharply when Trump was first elected, and they've fallen very sharply. So stocks like Tesla, some of those, I think Resolution Foundation, some of those other ones that were very Bitcoin focused and I guess crypto focused, have fallen very sharply. So I don't know for sure that it's true that it is mature enough yet to be a true counter to market volatility. I think what people have been still using as volatility is something very old-fashioned, gold.
Tremendous timing. We have a question from the Magnificent Puffin on YouTube. Are you investing into gold as a hedge? I mean, no, is the short answer. Sorry if that was for me. No, we're not. No, we're not. It is an interesting thought in many respects, because it's always been the go-to risk in risky environments that you go to gold. It's difficult to do. It's not in our asset allocation anywhere. It would be very much an active decision. It's totally outside of our investment philosophy. I don't know if you've got any comments you'd like to make, Shamubeel.
No, I mean, gold for me has been one of those completely unpredictable things. So typically gold and interest rates tend to go in opposite directions. And what we have seen is in the last few months, gold prices have gone up while interest rates have gone up. So who knows, right? It's I always struggle with commodities as an investment, because there is no it's hard to see the intrinsic value in it, unlike a company which is creating something and generating profits over time. But when I've invested privately in the past, I have often had commodities in my portfolio because they're fun as a punt.
Okay. Yeah, we're not in the business of punting. I mentioned Ice House and early stage companies. They're not. We don't have that available as an investment option. No, they are part of our growth and high growth funds. Icehouse funds are available to investors. You have to be an experienced investor to access those. But from our point of view, it's something that we feel that's a good idea for us to do to add some value to our diversified funds, but we would see that on its own as being a relatively risky investment. And so, no, it's not available on its own. I am 65 and currently caring for my parents aged 91 and 96. Good on you. I am tired of being told I should have a short-term perspective at my age. I may well live until my late 90s. How should I be managing this current crisis to ensure a long-term income? Thanks, Hira. And Hira, don't worry. I certainly don't think you should have a short-term perspective at your age. You're pushing my age. Sorry, managing the current crisis to ensure a long-term income. I again, usual comment, can't give personal advice, but from my perspective, having some funds invested for that long term is still the right thing to do. And if you are a little bit more risk averse, you might want to go in for a balanced fund that's got some fixed interest or bond exposure too. But fundamentally, as you rightly say, you could be here in 30 years. You don't want to have everything sitting in the bank earning 5%. Shamubeel, any?
No, I absolutely agree. I think it's really about bucketing those time horizons. I don't think you should be short-term at all, because you should be thinking about your long-term future. And some of the money you're going to need in your 70s and 80s and 90s, they should be invested for the long term. But there'll also be things you might want to do in the next 5 or 10 years that you might want to think differently about. It's really worth getting good professional advice on this kind of stuff, because you get a lot of tools in terms of how to manage it properly. Because people get too fearful of running out of money and they forget to enjoy life, and you got to do both.
You do. I think you've answered this already to a degree, at least, Shamubeel. What high value sectors does New Zealand have expertise in and invest in to improve long-term outcomes? I think we've covered that.
I think so. I think essentially the answer is we have expertise in both old parts of the economy and new parts of the economy. So examples are the productivity gains in industries like dairy and others had been extraordinary, but also we've shown extraordinary amounts of progress in the weightless parts of the economy, in video games, in film, in software development. So there's all this kind of newfangled things that we're quite good at as well. The challenge for us is how do we grow from small to medium to large? And that's the bit that we're struggling with, is our ability to scale from New Zealand is one that we have not been able to crack yet.
Question about the allocation that we have to our housing initiative in terms of the proportion that it is within the growth and the high growth funds, and how do we just a quick talk about our asset allocation process. Essentially, we look at that fund and see it as a defensive growth asset. It's going to do well out of making development margins out of its properties. It's also going to do well out of charging rent to the people that live in the properties once they're completed. And we saw that as a sector where there is a big hole in the New Zealand economy, and therefore it was a good area for us to put a little bit of our members' money in. The amount of the allocation is, it depends whether you think it is substantial or not. It's less than 10%, and it's a lot less than that at the moment. It will grow up to something like that. And as I say, we think it will show its value as time goes on, but it's not a significant. It's not a major part of any of our fund allocations, apart from the Homes and Income Fund, which it will get up to 25%. In all others, it's going to be limited by the fact, apart from anything else, that we have to maintain a high degree of liquidity in our funds, because people need to be able to come and go as often as they can. I hope that answers the question. I don't know if you've got anything you want to add, Shamubeel. No. We mentioned seeing people moving to more defensive funds as a result of the volatility, but given the downturn in New Zealand how are KiwiSaver accounts holding up? Have there been more net withdrawals? Are we seeing an increase in investing from Kiwis? Overall, we have been really encouraged by the continued investment coming through into mainly the non-KiwiSaver funds. KiwiSaver is steady. Everybody contributes without even realizing, for the most part, as it comes through their employer-employee contributions. And so KiwiSaver continues to grow, and we're, as I say, that's great. But we've been really encouraged by the amount of non-KiwiSaver money which has been coming through, albeit that, as I said before, more has gone into the defensive end of the spectrum more recently. But overall, everything continues to grow, which is great.
I'll just add that we are seeing quite elevated levels of hardship withdrawals across the KiwiSaver schemes, not just at ours, and that's not surprising given, I guess, how hard things are economically for a lot of people still.
Making sure I'm getting back to the beginning. Will the economic recovery that we're expecting this year reduce the rate that living costs are increasing, e.g. at supermarkets?
Yeah, look, inflation has moderated, and particularly in the retail sector, food prices have stabilized. So the economic recovery is less to do. I don't think the economy is strong enough to generate lots of price increases. So if anything, this year, I think we should be relatively confident that price increases will be modest compared to wage gains. So this is going to be one of those rare good years when the cost of living is not going to outstrip our wage increases.
A message from Carol rather than a question. If Simplicity ever invests in China, I will leave. And I appreciate the sentiment, Carol. But as I said before, the only way we would ever invest in China is if the regime there changes quite markedly from as it is at the moment. With volatility across the world currently, but particularly in the US, does a total world fund global index seem like a more sensible option than a US 500 at the moment? I mean, from a diversification point of view, which is always my argument, yes, a global fund is definitely, in my opinion, better as a longer term investment. Investing in a single country is inevitably more risky. But again, it's entirely up to your view of the world. It's not something which I would really express an opinion on. What are your views on interest rates going forward, especially with the uncertainties emanating out of America?
I think on balance, it means that interest rates will be lower than otherwise would be the case. More uncertainty means less risk-taking behavior, which would be encouraging a stronger economy. We will see people being less, I guess, aggressive in the way that they invest and spend. So I think monetary policy in New Zealand is quite responsive. Arguably, we were too slow to cut in the current recession, but by and large, I'd say the risks that we're seeing in the global markets right now and policy uncertainty will mean that, on balance, interest rates in New Zealand will probably be lower than would otherwise be the case.
There was a question there that's just disappeared, but was whether there's any changes to our ethical investment policy. At this stage, there's none on the horizon that I've heard discussed. In general, the whole approach to our responsible investment policy is just getting more and more refined over time. But no, I don't think there's anything new on the horizon right here, right now. Sorry, Guy, if you weren't aware, we've got a growth and high growth option. If you were to make the switch, all you would be doing if you switch from our growth fund to our high growth fund is you would be selling out of a small amount of bonds and buying more shares. I don't think I would call that a financial disadvantage, really. And with the fall off in equity markets over the course of the last 4 or 5 days, if anything, you're getting into the share markets at a slightly better position, but it's not material, or not significantly material. How, if at all, can Simplicity take advantage of the almost certain global increase in defence spending? Yeah, good question. I mean, I think we don't invest in weapons, etc., and we're not going to. However, the sectors that benefit from an increase in that spending will benefit. But it's a broader question than that, isn't it, Shamubeel? Because the money's got to come from somewhere to invest in there, and either it's borrowed or it's taken out of other sectors. So it depends exactly where the money comes from that is spent on defence, really. Not a particularly good answer. Shamubeel, you got any?
It's the broad question of what is ethical. And it's a really hairy, thorny question. Is defense now ethical because it's for self-defense versus attack, right? And so I think the position we've taken is when it comes to defense and weapons manufacturing in particular, that those are not things we want to invest in. And so we just need to be quite consistent in the way that we approach, so then our members can choose with their eyes wide open.
The next question is about how safe is my money if there were another GFC. The thing about the GFC was that the big losses in money were made, or the significant losses were made by people that were investing in some highly structured, highly risky products that they didn't realize. The broader perspective is that financial markets did bounce back. And so in terms of how much of your money is, if you like, at risk, we don't invest in anything like the type of products that caused the GFC. However, the other piece of reassurance that we should always make clear to investors is that your money is sitting in an account that's controlled by public trust as supervisor. We can move it, but we can't put it into our account, and neither can anybody else outside of the financial markets. So that's the safety of your money, in the sense that it's effectively still owned by you and managed or overseen by a supervisor. In terms of, as I say, a sort of a GFC, would you lose your savings if you don't have 10 more years to wait? But as I say, the GFC, the real money loss in the GFC was in quite specific sectors that were highly leveraged. The broader perspective was nowhere near so bad. Anything you'd add, Shamubeel?
No, look, I mean, unless you think the markets are going to go to zero.
Yeah, well, I mean, yeah, if everything's worth nothing. No, exactly.
Yeah.
Question from Brendan: are you happy that Simplicity makes ethical investments? To be honest, I mean, just in the recent past, there's been quite a lot of discussion about the word ethical internally here, because everybody has ethics, and you might not agree with other people's. What is actually ethical is a really moot point. However, am I comfortable that we think about exactly what we invest in continually and try to make sure that we're not investing in anything that other people would consider unethical? As I say, that's a broad spectrum, but yes, we try to make sure that we are, and I much prefer socially responsible, as socially responsible as we possibly can be. It's not an easy question to answer. Thank you for all these questions, by the way, everybody. It's keeping us on our toes. What are your perspectives on the performance risks and opportunities of international markets outside of the US, such as India, in the context of global economic trends and investment potential? Whoa. You got that?
I got nothing. This is your call, man.
Oh, I mean, yeah, I'll fall back on a conversation I had earlier today with somebody talking about macro flows, and there has been quite a marked move out of the US into Europe, in particular, over the course of the last 2 or 3 months, and I think that's reflecting what we've been talking about, the risks to the US and the way that it's conducting itself, for lack of a better word, just at the moment. So again, I know I fall back on it the whole time, but I just like the diversification that you have, where you've got something invested just about everywhere. That's just the safest way to do it from my point of view. Hi, Shamubeel. New Zealand's lack of productivity is mentioned often. What is productivity in this context, and how is it measured? Is it a synonym for growth? I know there are arguments now about whether growth is a good thing anymore, given resource impacts.
Yeah, so productivity quite simply is when we work harder, when we work, are we getting more returns as income or as profits? That's really what productivity is, that given the same amount of inputs of work, of resources, are we getting better off? So I think there's quite often a lot of confusion. People think, oh, it's all about growth by throwing more resources at it. In fact, it's the opposite. It's saying with the same amount of inputs, can we get better off in terms of incomes and profits? So more returns on labor and more returns on capital. And so, no, look, it's not a synonym for growth. I think that therein lies the challenge. Sometimes the conversation goes, if we just had more growth, everything would be better. Well, actually, more is not just better. It could be just more. You could have lots more people, but on average, we're not better off, or we're not getting the distribution of the returns across workers or different types of people. So, no, I think the productivity thing that we're talking about is, are we actually getting more efficient? And as a result of that efficiency, are we getting better choices as business owners and as workers? That's what productivity is about. Ultimately, the impact has to be on people, the human impact of it, which is, are we making less of an impact on people, on the environment, on resources, but still getting better off in terms of quality of life and the choices and options that we have. So that's the kind of the philosophical thing that we're trying to measure. But physically, what we measure is wages plus profits divided by workers.
And the next question is a bit difficult because I don't know the answer, and I'm not sure whether you've got a view. But for Martin, in relation to New Zealand's R&D weakness, do you have any thoughts about the recent government decisions re the Callaghan Institute?
Look, it's a really hard question because I'm not an expert on the science system, but again, the macro answer is our R&D has long been low, including when we had Callaghan. And so, Callaghan's just a new name for what we had with Morst and Forst in the past. So it's not like New Zealand hasn't had some kind of government efforts to try and do more in the research and development space, but New Zealand has consistently underperformed for a very long time. So I suspect the optimistic and positive kind of way of looking at it is, if we're not going to do it the way that we have done, what are we going to do differently? Are we going to have sufficient amounts of work in our science sector? And will that spill over to better benefits for New Zealand as a society? And I think that's an open question.
Great. Now, this is a reply to one of my answers with regards to more information about Simplicity Living and the other private investors. And sorry if you thought my answer was no. I wasn't saying no. What I'm saying is that we would like to, and we are going to. It's not as easy as simply putting something up on the net, because there's regulatory issues around what we disclose and how much and to who. So we're working on it, and we will be giving more information about those investments. But right here, right now, we can't. Thank you, all those that are saying thank you. Any plans to introduce a standard S&P 500 index fund? I mean, no is the short answer. I mean, when we introduce any product to the market, the fundamental question we ask ourselves is, how are we providing better retirement for our members? That's always been the key point. And sometimes products like our international funds are a result of something else that wasn't the original intention of launching them as they are, but that's worked out quite nicely. Having a specific S&P 500, I can't think of a reason why we would want to do that, but sorry. The question, read the index. Oh, thank you. Thank you for this. The question, read the index, was why specifically the Bloomberg DME rather than another index? E.g., does someone like Vanguard offer an ESG screened world index, and why the Bloomberg is something else? That's a very good and detailed question. The Bloomberg Developed Market Index is designed to, DM is the Developed Market Index, is designed to be very much the MSCI World or the FTSE or the others. That all the index providers have a very similar index. They've got different ways of constructing them, but they perform. If you take a completely unscrewed index, they perform extremely similar to each other. The reason we went with the Bloomberg Developed Market Index and then put our ESG screens over it was massively to do with the information they were able to provide us relative to their competitors, but also the deal that they were willing to do. Index information is actually quite expensive, and they were able to put a package together for us that made it very lucrative. And we pay their fee out of the fee that we charge you. You don't pay it. So the more we can push those fees down, the less we need to charge our members. But that was why we went with that one. Vanguard, they don't run an index. They run a fund that would have an ESG screened index, but that's much like our fund. I hope that answers the question. Sorry. Wouldn't a global downturn mean New Zealand would not recover and stay in recession?
Not necessarily, because essentially the economy is made up of what's going on in the consumer sector, what's happening in investment in New Zealand, and what's happening with the trade. And the trade part tends to be the most affected by what's happening in the global economy. So you're absolutely right that it's a risk. If the global economy is very weak, then New Zealand will be affected. And we tend to be affected pretty hard on our export side, right? And so that spills over to the wider economy. But it doesn't necessarily mean the domestic economy be affected in the same way or to the same extreme extent. So right now, what we're looking at, I think, is just it's uncertainty. We don't know for sure whether the global economy is going to slip into recession. What we're seeing is the global economy is bumping along rather than being very weak. So look, again, it's not so much that we are thinking that there will be no risk to New Zealand. It's more that right now the domestic conditions in New Zealand are improving, and we're keeping a watching brief on the global conditions.
Perfect. Thank you for your question, Bevan, because you've obviously been reading some of Shamubeel's research. It says Australia has an 11 to 12% employer contribution to their funds. We are 3%. Do you think New Zealand should stagger a 0.5 increase a year over 5 to 10 years to catch up? Appreciate your comments.
Yeah, look, excellent question, Bevan. And the answer is we would love to be able to replicate what Australia has done, because what they have done what they did in the 1990s is make their superannuation scheme sustainable by helping people save enough in their retirement. So I think at the moment they're going up to 12.5% contribution, and the way their contributions work is it's not linked to the employee contributions. So I'd love to be able to see that. So that's something that we're working on at the moment in terms of how do we mature KiwiSaver in New Zealand. I think that was the reason Sam brought me on to the team, was how can we make KiwiSaver better? Because it's already a fabulous thing. We are already doing many of the bits of retirement savings really well. And the question is, how can we make it even better? So I'd love to be able to see contributions rate increase over time, but it's really important that we do it in the right way. So there's a few fish hooks that we need to sort out along the way, and that's what we're working on. So watch this space. Over the course of the next month or so, we'll be putting out our first report on how we can be much more ambitious and effective with KiwiSaver in New Zealand, because I think it's going to be fabulous.
Great. I knew you'd like that one. So a slight sidetrack, which it is a little. Have we heard anything about the government's intention in regards to open banking? We thought it was meant to be implemented at the end of last year. I've got a bit out of touch with this actually. Shamubeel?
No, the last time I heard was when Andrew Bailey was talking about it, and in terms of the work that had been going on. So that had been progressing at pace while Andrew was still there. But now that he's not there, I'm not sure what the state of that progress is. So I can't tell you with any more detail, unfortunately.
No, sorry, and I'm the same. But I mean, something which we were keeping a very active eye on. It's gone off the radar a wee bit, actually. Thoughts on the BRICs, the BRICS? How flexible is simplicity to move if we have a change in world order, or what are the impacts to the New Zealand dollar? I mean, in terms of how flexible are we? We take everything as it comes to a degree. It would, it'd be fascinating to see world order shifting that quickly. I'm not sure it will, but we will move if we need to. Shamubeel, in terms of the impacts on the New Zealand dollar, if the BRICS became a greater part of the world?
Well, I was actually working with Jim O'Neill when he did the whole BRICS thing. So the BRICS kind of collection is kind of a bizarre one because those are not countries that are actually going to be presenting the new world order. Within that, I think certainly the Russia, India, and China will be quite big players, but in different ways, in different things. I don't know. The answer for me is I don't know because we don't know what that would mean. Because it's not just about the size of these economies, it's about what impact they will have on the way that we do trade, the way that we do defense, and the way that countries can cooperate and work with each other. So it's a very big question, and I don't know if I have a good answer for it.
And in terms of the flexibility of us reacting to it in exactly the same way as Shamubeel's saying, but from a market's point of view, it's the same as the question on China from earlier, is that if they've got a completely transparent, well-regulated market, then it's possible. But the reality is that seems to be some way off. Question from Jonathan for you. Great. Shamubeel, multiple times in New Zealand and global central banks history, central banks have dropped rates too quickly, too early, only to have them rise again. How do we know this won't happen again?
We don't know. And the thing is, the future is unknowable. And that's always the difficulty in policymaking. It's very easy for people like me on the sidelines to say, oh, they made a mistake. But because the way to think about, I guess, interest rates is what they do today is going to influence the economy in 12 to 18 months' time. And we don't know what's going to happen in 12 to 18 months' time. And that was the reason I think in the current cycle, the Reserve Bank has been so slow to cut interest rates, even though the economy was very weak. Because inflation had been holding up, they waited a long time to make sure inflation was under control before they really started to cut interest rates. So no, we can't be sure ever. And I don't think we should ever hold our central banks and our policymakers to unreasonable standards. If the facts change, they should actually change what they do. And so I'd rather, if they made a mistake, actually correct the mistake rather than pursue our course of policy just because to save face.
Thank you. Now, a couple here quickly. How much of your funds are linked to Israel? Is that considered as part of your green investment funds at Simplicity? In the global funds, there are a couple of Israeli stocks, I think. It's quite small. They're simply invested in as part of an index strategy. And I'm not going to express any comment on politics or ESG on that score. And apologies, somebody's taken some issue with something I said about us not knowing how long we're going to live. I meant specifically, I understand that on average there are mortality rates, etc. But I was really speaking about how long I think I'm going to live.
But
productivity.
Also, Andrew, just on that though, it's that we know the average, but we don't know the distribution, right? There is always a distribution around the average. Some people will live longer, some people will live less. And so I think when you're planning for your money, and this is a big concern for a lot of people, is on average how long somebody might live or somebody from a particular background might live. But you personally might live longer or less. And that uncertainty is something that's really difficult for people to manage. So I don't think it's a comment per se on mortality rates not being known. It's more around, yes, we know about mortality rates, but what does it mean for you as an individual?
That's right. And if you've got an insurance portfolio with thousands of people, you've got some confidence over when they're going to die, but not an individual. Productivity from Ellen. Wouldn't it be still positive if instead of more profit returns for what we put in, more people get to stay and work and earn a fair wage, or would this fair sharing be counted as less productive? Oh, sorry, I haven't read that out particularly well. Are you reading it as well, Shamubeel? Oh, yes. I see. So would it still be positive if instead of more profit being made, more people get to stay and work and earn a fair wage?
Yeah, it would. So essentially, productivity is wages plus profits divided by the number of workers. So we can't ever look at one metric and go, this is good or bad. So there is a picture in terms of productivity. On average, are we getting better in the way that we do things? And then there's a second question in terms of how is that returns to work? How is that being shared between the owners of capital and the providers of labor? And to your point, if people are getting better off in terms of getting better wages, better working conditions, those kinds of things, then that would be counted as productivity. So again, it's like with anything with economics, like we can't take a single measure and go, this is the best measure and we should only do this. Life is much more nuanced and complicated than that. And these measures are kind of a starting point for us to have conversations, but they're never the end. And fundamentally, like I truly believe that the purpose of the economy is to make more New Zealanders better off. So if we're not getting better off and sharing it more broadly, we're not doing a good job. So that's why I think it's really hard to kind of focus on just single metrics.
That's great. Thank you very much, everybody, for the positive comments. I've got one last one. Is in Simplicity currently exploring investment opportunities in AI? And if so, what form might those investments take? Are there any ethical implications? Good question. I mean, in terms of what investments are we making, we're making the investments into the companies that are in the indices that we track. It's something that we're actively working on very hard internally to improve productivity for ourselves and to create better tools for our members and to create greater efficiencies. It's quite an emphasis for us internally. Ethically, that's an interesting question. I mean, I think one of the things about the ethics is the irony, and I'll just pass on one tiny piece here that I found quite interesting, is that from an AI point of view, if you're using an AI engine and you put in a question about your financial markets or what options you've got between investing in balanced growth, conservative, or whatever, nobody can control the answer you're going to get out of an AI engine. Where I can't give personal advice, and neither can Shamubeel, and neither can anybody else that without a whole load of disclosure. But in AI, somebody can put in a question and get an answer, and they might be happy with it, and they go off and implement it, and nobody's got any. There's no comeback. So I think there are always going to be some ethical questions about these things. But I don't know if you've got any thoughts, Shamubeel.
I think the other part of it is investing in the companies that are developing this AI technologies. And as you have seen in the last little while, we've seen extraordinary volatility in these prices, massive run up in prices, and then quite a big come down in the last few weeks. So when it comes to investing in new technologies, it's always fraught with it's always a bit fraught. And that's why we take an index and broad diversified approach to investing. So we benefit from the rise, but we're not super concentrated in making strong bets on any of these things. So, our strategy is always about being very diversified and tracking the market rather than trying to pick winners. Because, from the beginning, our philosophy has been about making sure that we are low cost, as passive as possible, with that kind of overlay of excluding those things that we consider unethical. So, look, I think our fundamental premise is still, yes, we are invested in these things, but as very tiny portions of our investments. And I should say that our disclaimers are on our website with the research that I send out. Because we can't give personal advice and economic advice is very general in nature. Please take all of these answers and conversation today in that context.
That's great. Well, thank you. We have got through the questions. I'm not sure how many people are still logged in actually, but thank you very much for listening. And we'll do this again soon, I hope. Thanks again.
Thanks, everybody.